Welcome back to The Close. It's time now for our Wall Street Week Daily segment with the host of Wall Street Week, David Westin, who joins us every day around this time. And David, we know this hasn't been the greatest year for M&A and volumes here, but we know these things tend to be sort of economically cyclical, and I guess a pickup is going to come soon.
Well, exactly, Romaine. After all those record years, now we've had some fallow times, and the question is it coming back, and if so, when? To give some answers, we have the person who knows. He's Bill Curtin of Hogan Lovells, where he's global head of M&A. So, Bill, welcome back. Good to have you here. So, is there a pipeline building? How can we tell?
Yeah, it's coming back, right? We had the heydays of 2020, 2021, when we broke every record imaginable, both by volume and by value of M&A. And then it came down and pretty dramatically, particularly on the value side. But I see the green shoots again. I see it. The bankers see it. We're preparing with the C-suite. We're looking at transactions again. And so I'm actually pretty optimistic. I'd call it measured optimism about the next 12 months that are in front of us.
If there is a pipeline building up, what is going to be required to release it? What is actually going to trigger the actual mergers and acquisitions?
Right, David. So we think about our reality right now where we are. We have dramatically changing landscapes in how we move people, how we move things, how we catapult technology forward, energy transition. All of these things require non-organic activity in the form of M&A, right? So we have these amazing propellers that are happening. On the other hand, we have a lot of headwinds in front of us. We have regulatory headwinds in front of us. We have financing headwinds in front of us. On the regulatory side, we have very active, engaged antitrust officials and regulators. We have more expensive debt in the market, harder to secure debt in the market. And then we also have national security concerns. So I think about it. I was at LaGuardia the other day, David and Romaine, and I don't know if this has ever happened to you, but we were stuck on the runway for quite some time waiting to be given permission to take off. And I think about all those planes on the runway as M&A deals. And I think about the C-suite in the cockpit and telling us, hey, when can we take off, and how high do we fly? Where do we fly? Because there are these headwinds out there, but we have to go. And that have to go is because of the technology propellers that are occurring and all the dynamism in the marketplace.
Well, let's talk about some of those areas then. I mean, obviously AI, artificial intelligence, has been sort of the shiny new object here. And there's been a lot of discussion that, particularly on the periphery of that, not just the core chips that go into this, on the periphery of that, there's an entire ecosystem that is going to be ripe for M&A activity. Are you already seeing that?
Yeah, so look, Cisco made their move with Splunk, right? And everybody took note of that. And we know that Amazon and Google are both looking as well. And they're investing in this space, and it's a reality now. 6 months ago, you had to talk about AI, or else you watched your earnings, right? In your queues, you would have a problem, right? So the CFOs all talked about it. Now they have to implement it, and they have to implement it meaningfully. So I expect a lot of transactional activity there, Romaine, by definition, because you can't do it organically, right? The R&D investment, the quantum and the amount of time is such that you need to do that through M&A. So I see that. I also see a lot in the mobility space. I see a lot in the EV space. You know, if you think about all these oxymorons right now pushing us toward more M&A, notwithstanding the headwinds, the 15 districts in the United States of America that have received the most investment for EV under the IRA, guess what? They're all Republican districts. Every one of them is a Republican district. They're in the South, the Southeast, rural areas. They love this influx of capital and investment and job opportunities. So we have all these propellers moving us forward, and we just have to find a way to navigate through the FTC, the DOJ, the National Security Department, and like.
Well, let's talk about that, because as you know, the environment for M&A deals from a regulatory standpoint is way different than what it was even just a few years ago, maybe 3 or 4 years ago here. And I'm curious as to how you square that circle, because we're not just talking about, oh, we're just going to look at the behemoths and block a deal if we think there's a monopoly. They're looking at smaller deals now and saying, could this be a monopoly in the future, and maybe we should nip it in the bud now.
You said it exactly right, Romaine. It's incredibly prospective, the way the regulators in Washington, D.C., and in Brussels, and in London. Because, of course, London's got their own CMA now as a result of Brexit and the like. So you have a triangle there, right? And they're prospective policy making in the way that they're reviewing and scrutinizing mergers, right? We have the draft regulations that are now out, that are under review, and they haven't gone final. They're open to comment. The regulations look, just as you said, Romaine, so different than what we had before. Before, it was about market power, pricing control, right? Now it's about, are you transacting in a way that makes things less competitive? And the proposed rules even talk about what less competitive means. Not as good for the labor force, preventing nascent technologies from coming into play, or even pursuing serial transactors. Think about that. You do M&A on a recurring basis, and you're subject to more scrutiny.
Private equity, as President Biden has talked about, right? But we had Lina Khan, the chair of the FTC, on Bloomberg yesterday, and she said she's as concerned about the deterrent effect as actually winning cases. She's lost some big cases, as you and I both know. Is she having that deterrent effect in your experience as you talk to CEOs and CFOs?
I expect less and less. My view is that will
less
occur.
and less deterrence.
Less and less deterrence. More and more activity going forward. What I hear from the C-suite right now is not whether we can do a transaction, David, how we can do the transaction. So increasingly, these deals are getting lined up for 2024. That's why I'm measured optimism for 2024, with the C-suite saying, we want to get over that mountain there. We want to bring in that capability. We want a joint venture in that geography. Tell us how we can do it, not whether. 6 to 12 months ago, David, it was more whether. Can we? Will we get blocked? Will we be sued by the United States government and lose? Now they're more inclined to say, just tell us how to do it because we believe we can, right? So the track record here with cases settling, cases being lost by the United States government, are such that there's more of a sense of confidence and more of a sense of let's go.
Bill, one question is, can we do the deal? Another is, can we afford to do the deal? We now have rates higher. We have yields higher. How big an impediment is that to this pipeline really getting unleashed?
It's significant. It's real. It's gotten more expensive, right? We heard Jamie come on, on your show, you've had wonderful guests who've come on and even talked about the possibility of a 7% environment out there.
Yeah.
We think, Romaine, it'll be more like 5.5 to 6, but we'll see. It's more expensive. And with that, David, at the same time, it affects valuations, right? Because the valuations out there have to get reset to accommodate the more expensive nature of the acquisition financing. And when the valuations get reset, the sellers, who are quite proud of their assets, get a little bit less inclined to part ways with their assets.
But this also goes back to the whole idea of the pipeline and your analogy of the planes on the runway. I mean, some of the big deals that we've seen this year have been largely cash deals.
Yes.
We haven't seen as much financing and even use of stock, not quite as much as what we have seen in the past.
That's right. Well, there's so much cash that's been stockpiled.
Okay.
So what I think is really interesting to your point, Romaine, is people learned from 07, 08, right? And people froze after that moment in the M&A community. We just stopped. Well, this time around, what have people done? They've continued to work on their balance sheets, right? And because those balance sheets at this moment are so much stronger, the strategics and, of course, the dry powder rich sponsors are ready to go. They've just been waiting, as David said, to see that the skies are friendly. And if the skies aren't friendly, they don't want to take off. So you have a lot of planes at LaGuardia, right? Today's a beautiful day in Manhattan. But there have been a lot of planes that are looking, and those planes are fueled, staffed, and ready. And I think we're going to see more of them lifting and navigating the obstacles.
I love your airline analogy, but I wish you would have picked a more efficient airport than LaGuardia.
I do like the new terminal.
It is nice.
Okay, thank you so much to Bill Curtin, Hogan Lovells partner and global head of M&A. And tomorrow, we're going to be joined by Our Crowd founder and CEO John Medved to discuss the impact potentially of an Israeli-Saudi deal, what that could mean for the Middle East and for global growth overall. Then on Friday, we're going to hear from Ruchir Sharma of Rockefeller International on Wall Street Week at 6 p.m. Eastern Time, talking about whether, in fact, the United States has basically had its best shot at stimulating its economy. That's coming at 6 o'clock on Friday.